Welcome back, everyone. Today, we are going to discuss the accrual basic accounting. Our agenda will be, firstly, what's accrual accounting, impacts on operations and reporting, who uses accrual accounting, bookkeeping for both seller and buyer, and finally, comparison between cash and accrual basis. Firstly, before we continue discussing other financial statements, we need to understand a very important principle, which we have mentioned earlier, the accrual accounting. We didn't explain it yet, but we mentioned the name. Accrual accounting is standard normal practice for majority of businesses, large and small, worldwide. Accrual accounting is the practice of accounting for revenues in the period the firm earns them, and for expenses in the period the firm incurs them. Under accrual accounting, for instance, sellers record a sale as revenue earned, even if the customer has not yet paid. Until customer pays, the seller carries the revenue earnings as either accrued revenues or accounts receivables. I think you have heard of the terminology account receivables before. Now it's whether accrued revenues or account receivables, and both are asset accounts. Accrual accounting contrasts with cash accounting or cash basis accounting, which records only cash receipts and cash payments. As we discussed, the income statement shows a company's profit, but profit is not the same as net cash flow, which is how much cash the company generated during the period. Revenue is considered earned when a sales transaction is identified by certain conditions. For example, whether the products have been shipped to the customer or not. But the cash flow from the transaction, which is the cash received when the customer pays the bill, usually occurs later, which is a common situation when the customer buys on credit. In this case, there is initially revenue without cash. However, a company acquiring or producing a unique item for a customer may require payment before the sales transaction is completed and the revenue earned. Only in this case, there is cash without revenue. But this is not the common business scenario at all. Likewise, an expense can be incurred and accounted for without being paid if a supplier extends credit, or an expense can be paid for before it actually incurred, which means prepaid. For example, like paying your rental cost for your apartment in advance. On the income statement, profits are measured on an accrual basis, which means that revenues are recorded when the revenues are earned rather than when they are received in cash, and the related expense may be recognized before or after they are paid out in cash. Because of the timing difference between when the revenue are earned and when customers pay their bills, the cash received during a particular period is not likely to be the same amount as revenues earned during that period, unless all sales are for cash or cash-based. Equally, the cash paid for expenses during the period is not likely to be the same amount as the expenses recognized on the income statement. Thus, profits and net cash flows are typically not the same amount. There are other reasons why the profits measured on the income statement are not the same as cash flow. For example, the balance sheet reports long-term assets when they are acquired. As we know, the balance sheet has assets, liabilities, and equity. But there is no long-term asset expense shown immediately on the income statement. Instead, the use of the long-term asset is expensed on the income statement over its useful life by using what we have defined before, by depreciation expense. So the asset is shown on the income statement by the depreciation expense only. This depreciation expense does not correspond to a cash flow. As we agreed, it's a non-cash transaction. The cash flow from the asset or for the asset acquisition happens upfront when the asset is acquired or purchased. So in the cash flow statement, the whole amount of the asset was charged as immediately when the asset was purchased. A company must eventually generate profits to provide returns to shareholders, but it must generate cash to keep itself going. Suppliers, employees, expenses, and debts must be paid for the company to keep operating. The income statement indicates how good a company is at creating profit, but it's also critical to see how good the company is at generating cash. A company can be profitable but have negative cash flows. For example, if it's low at collecting cash from its customers, so they are not collecting as much cash as they should have been doing. Or a company may operate at a loss but have positive cash flows. For example, if the company has high depreciation and amortization expenses, which reduces their profit on the income statement. As we agreed, in the income statement, we have the depreciation and amortization expenses, which are non-cash equivalent or non-cash transactions, reducing the income on the income statement, but don't reflect on the cash statement, as they are non-cash transactions. A company can operate at a loss as long as the owners allow it, provided the company can generate cash flows to support its survival. But a company cannot survive long with negative cash flows, no matter how profitable it seems to be. Negative cash flows may cut off access to resources such as material and labor and can cause a company to become bankrupt because no one will be working there, they are not able to pay their liabilities, so they will go bankrupt. The use of accrual accounting on the income statement creates a need for a separate statement to track the company's cash. This separate statement is the cash flow statement, which we will discuss in later videos. But who uses accrual accounting and how the decision is made? When a new company is set up, owners establish several characteristics of the accounting system the company will use. Firstly, they define the company's fiscal year or financial year, which will serve as the organization basis of financial budgeting, planning, and reporting. Secondly, they have to decide the accounting system. They must choose either accrual accounting or cash accounting, or maybe hybrid combination of these approaches. Some small firms are free to choose cash basis accounting. However, most of the companies who can choose between systems often choose accrual accounting, no doubt because of several built-in advantages absent in cash accounting, which we will discuss in the advantages and disadvantages later. Government regulators and tax authorities in most countries require certain companies to use accrual accounting only for reporting purposes. Accrual accounting is mandatory for public companies. Public companies are those that sell shares of stock to the public. They must use accrual accounting for reporting to regulatory bodies and when sending the annual report to shareholders. Public companies must use strict accrual accounting for reporting because regulators and tax authorities mandate reports that conform to the country's generally accepted accounting principles, or GAAP or GAAP. And for public companies in private industries, GAAP supports accrual accounting but not cash basis accounting. This mandate is a near universal rule everywhere, unlikely to reverse in the foreseeable future. However, GAAP, which is, as we defined, generally accepted accounting principles for government and non-profit organizations, differ from GAAP for companies in business. As a result, these organizations are often free to choose between cash accounting, modified cash accounting, or accrual accounting for reporting purposes. Nevertheless, there is a worldwide trend towards accrual accounting for these organizations. Let's look at an example showing two different cases. The first case is when the buyer pays before the seller delivers. The second case, when seller delivers before buyer pays. And let's see how this shall be recorded in their books. Let's look at the seller perspective first. The prepayment situation occurs when customers pay before receiving goods or services. That is unearned revenue situation. The seller claims unearned revenues or deferred revenues as revenues received for goods or services which are not delivered yet. The seller records unearned revenues as liability until delivery of goods or services take place, as he is obliged to deliver. After delivery, the funds become revenue earnings for the seller. So, what about the buyer's perspective? The buyer claims deferred expenses or prepaid expenses or deferred charges when paying for services or goods before delivery. The buyer carries deferred expenses as assets until receiving or consuming the services. For example, a 1-year subscription to a computer backup service paid in advance is a deferred expense. When firms pay taxes in advance of due date, they create prepaid expense. Or another example, floor space rental in advance of occupying it. This is also prepaid expense. One example that we are all doing for airline tickets before the flight, this purchase creates a prepaid travel expense until the trip occurs. Insurance premiums before the start of the coverage period. The insured party can carry these costs in an asset account, which is prepaid insurance account. We can have a lot of examples. Let us look at the other way around perspective. Deferred payment, when the seller delivers goods or services before the buyer pays. For the seller, in the deferred payment situation, the seller who delivers goods or services before the buyer pays records accrued revenue or accrued assets or unrealized revenues or accrued sales because he delivered his goods but not yet paid. Sellers may post accrued revenues in an asset account such as accounts receivables until the customer pays cash. Then, when the customer pays, the seller credits or reduces accounts receivable while at the same time debiting or increasing another asset account, which is cash. Okay, from the buyer's viewpoint, buyers report accrued expenses or accrued liabilities as it's a liability on them, or deferred expenses in their books, registering their debt for goods and services purchased but not yet paid for. For example, when employers owe their employees salaries or wages for work completed but not paid them yet, the employer has an accrued expenses, which is the salaries. Another example, interest payable for a bank loan can be an accrued expense. The borrower first enters them into the journal as a liability until the customer pays, at which time, the customer debits the liability account or reduces account balance, and at the same time, credit or decreases an asset account such as cash because the payment was done. Firms first enter accrued expenses in the journal as liabilities until they pay them because they have to pay it anyhow. Firms debit or reduce a liability account when they pay because the payment was done, so no more liability. At the same time, they credit or decrease an asset account such as cash because cash was reduced because it's already paid to the other party. Let's see an example to understand that better. An example with numbers. Consider a sale transaction for a manufacturer selling goods to another company. On August 15, Seller Corporation sells and ships goods to the buyer. Along with the goods, the seller sends an invoice for $65,000, marked with net 30, which means that the buyer must pay this bill in 30 days or less. At sale closing, the seller records the sales revenue and new value in accounts receivables as follows. They add a debit transaction for $65,000 on the account receivables, which is an asset category account. A debit increases the balance in asset accounts. At the same time, the seller credits or increases the balance in sales revenue, a revenue category account. The sale transaction is now on the books, even though the buyer has not yet paid. We are now talking about seller's book. If the buyer makes a cash payment in 30 days or less, which is a very ideal case, say on September 1st, the seller preserves the $65,000 sale value by moving it from one asset account to another, which is, in our case, the account receivable to cash account. So they receive the payment, so it's no more in the account receivable. It should move to cash account. So no change in the assets. Here the seller debits or increases a cash account and credits or decreases accounts receivable with the same value. So no change as shown in the table. Assume now, however, that buyer does not pay ever. Instead, buyer declares bankruptcy and goes into liquidation. So on October 15, buyer's liquidator sends an unpleasant message to the seller. Seller learns that asset liquidation will not generate funds enough to cover the debt. The firm must now recognize formally that it will never recover the $65,000 debt. So seller must, in other words, register a bad debt write-off. In that case, seller can begin the write-off process by recognizing a bad debt expense and an allowance for doubtful accounts with these transactions shown in the table. Seller makes two account transactions at the same time. Firstly, sellers debit or increases the bad debt expense by $65,000. So they are having a bad debt or unexpected payment of $65,000. Second, seller credits or increases allowance for doubtful accounts with the same amount because the allowance for doubtful accounts is a pool of payments that you are not expecting it to be paid to you at all, or you're having a doubt, which means that sellers started to have a doubt that they will get paid by the buyer. So seller recognizes this value as part of the allowance that he considered for some payments that will not be received. And the allowance for doubtful accounts is a pool where the company puts any payment that it's doubtful that it will not receive. Note, by the way, that allowance for doubtful accounts is an asset category account, but it's also a contra asset account. Don't worry now about the name of contra asset account, but I just mentioned the name because only here in this account balance increases with a credit transaction, just opposite to the impact in normal asset account, which should have been reduced if credited. So here we increase the allowance for doubtful accounts by crediting it. Later, nearer to the end of accounting period, when the seller is completely certain that customer will never pay, seller completes the write-off process with these transactions in the table. In this case, with the write-off, seller's next income statement still reflects the $65,000 sale. Seller did achieve the sale. However, just under the income statement, revenue figures appears as bad debt expense with the same value. So, as you can see, the seller debited the allowance for doubtful accounts, which we remember it was a contra asset account, which gets reduced now if debited. So the seller reduced the old allowance for doubtful accounts, not because they are paid, but because they are definite that they will not be paid. So they have to reduce the amount from the receivable amount. So now, as you can see, they credited the accounts receivable, which means to credit the receivables account with the same value, announcing that there will be no receivables at all. Okay, for the buyer in this example, accrual accounting also keeps the sale on books from the moment the sale closes. In this case, buyer bought goods from seller, expecting not to pay immediately, but to receive an invoice with a note of net 30, which is to be paid within 30 days or less, for the value of $62,000. Assume that buyer expects to add these goods to its inventory and ultimately to sell them. In that case, buyer could record the sale as shown in the table. Inventory is an asset account. Asset account increased by a debit transaction. Accounts payable is a liability or debt category account, increased by a credit transaction. So assets increased and liabilities increased as well, keeping the balance in the balance sheet, if you remember. If buyer actually did send a cash payment of $65,000 on September 1st, buyer's accrual accounting system could include these transactions shown in the table. The liability account or accounts payable is reduced by a debit transaction. Cash is an asset account reduced by a credit transaction with the same value, so payment is done. In managing finances, companies in business must simultaneously pay attention to two different considerations. The first one is the timing and management of revenues, costs, and expenses, which is critical for reporting earnings and determining taxes and declaring dividends. The second point is the timing and management of cash, which is critical for meeting obligations and business needs, like paying employees, paying interest on loans or bonds, or investing in new product development or infrastructure upgrades, or any other example that needs cash. It should be no surprise that for most businesses, accrual accounting is the best option for managing revenues, costs, and expenses, while cash-basis accounting is in several ways better suited for managing cash flows. The distinction between cash accounting and accrual accounting can be sharpened further with a brief review of some advantages and some disadvantages to each approach. The final section of this presentation describes ways some companies attempt to benefit from the advantages of both of them. Firstly, the accrual accounting. If we go to advantages, the accrual accounting describes accurately sales transactions that are only partially completed, where customers have received goods and services but not yet paid. Such situations are invisible to cash accounting. They are not shown in the cash accounting at all. Accrual accounting makes possible the application of the matching concept, the idea that firms report revenue in the same period as the expenses that brought these revenues. Accrual accounting has the advantage of immediacy because the firm records sales revenues when they earn them and expenses when they incur them. The company knows immediately what it can expect in both categories, expenses and revenues. Accrual accounting has one form of built-in error checking because accrual accounting is implemented with double entry bookkeeping and accounting in which the sum of total debits must equal the sum of total credits. This relationship is tested every reporting quarter and every reporting year during a trial balance period. But some disadvantages of the accrual accounting is that accrual accounting is not well suited to managing cash flow for budgeting and planning purposes, because the benefit of immediacy is also a disadvantage concerning cash flow management. Cash flow management is not immediate under accrual accounting. The understanding and using accrual accounting requires an understanding of double entry accounting and bookkeeping. Many business people lack this understanding. For most companies, the use of accrual accounting requires professional accountants, and this is considered somehow a disadvantage of accrual accounting. On the other hand, cash accounting. Cash accounting have immediacy, whereas cash accounting does not readily give immediate information on earnings and expenses. Cash accounting does give immediacy to cash inflows and outflows. Cash basis accounting is simpler than accrual accounting. Those without a background in accounting or bookkeeping can readily learn and apply cash basis accounting, and this approach is understandable to a much wider audience than accrual accounting. Many small companies can use the cash basis approach without involving a professional bookkeeper or accountant. The cash basis approach does not require complex accounting software. Firms can easily create and maintain a cash basis single entry system in a written notebook or a very simple spreadsheet. But some of the disadvantages of the cash accounting is that cash basis accounting does not conform to GAAP or generally accepted accounting principles, because in almost all countries it's required to report using the accrual accounting. That means that public companies cannot use cash basis accounting for reporting to shareholders or tax authorities. Cash basis accounting does not allow for tracking actual dates of sales and purchases. This limitation is not a problem for businesses that always receive payment immediately when they make a sale and always pay immediately when they incur an expense. This limitation does create a problem for companies that sell on credit or invoice customers after a sale for payment some period later. Under cash basis accounting, firms do not record partial payments done by customers as such, and therefore the cash accounting balance sheet may not reflect all payments due. By that, we have done the discussion and the comparison between both types, the accrual accounting and the cash accounting, and I hope by that you have understood the difference between both and when we can use each one of them and what are the privileges that accrual basis accounting has. Thank you.
you.